Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, November 8th, 2012. And what I wanted to do in this video overview is take a look at where we are right now in the markets and what to expect going forward. Tonight I don't plan to spend a lot of time on talking on all the details on these charts. For those of you that follow the site, I've covered the broad indices quite extensively lately. And for those of you new to the site, you can reference those old previous posts, charts, and videos on the site. On the top of the page, there's a menu up top. Just go under Market Analysis, click that tab, and take a look at General Market Analysis. And you can also go to the right-hand side of the page. There's a column category labeled Post by Symbol. Choose that drop-down box, and then right there in the beginning, the first dozen or so symbols are different indices, anything with a dollar sign in front of it. So choose the SPX, NDX, and you can quickly reference those past posts and comments. Okay, so we are taking a look here at the weekly chart. I'll try to do this video as quick as possible. If I forget to mention our time frame, if you look here at the upper left hand side of the screen, this shows the time frame that we're on. So we're looking at an S&P 500 weekly chart, and I mentioned yesterday, I believe, there was a key support level we were at. That is this yellow uptrend line that's off the 2009 lows. So this defines this uptrend line has defined the entire bull market run. We've had various trend lines along the way. Again, I've talked on those in the past, and each one broke down. So these sort of work in a fanning type cluster, these trend lines. But this is the latest uptrend line, which has been in play for a while, and this downtrend line off the 2007 bull market highs, we recently had a bullish breakout and bear trap when prices came back down, which actually, as of today, are now back down below that. So I wanted to highlight that. We'll zoom in here a bit, and as you can see, this candlestick, we're now well below both those two trend lines. And now, of course, we're looking at a weekly chart, and on weekly charts, you want to wait for the week to finish out, because anything is possible. The powers that be can step in, market forces, whatever. We could have a big up day tomorrow and prices could come back under here, just as, here's a good example, this candlestick here. We broke below that trend line and had a powerful move back up. So trend line breaks, can work two ways. I've been talking a lot about bull traps lately. Bear traps are possible. I do not expect that. I'll make that clear. I'm not trying to be ambiguous here, but it is possible and something we'd have to keep an eye out for. There's another example down here. So okay, so let's take a look. These horizontal lines are key support levels that I've marked, and this first line, we're not too far. We closed today at 1377.51, as you can see over here, and the next key support that I see below is 1365. So we're less than, we're about 12 points, just 12 points above a key, potentially key support level. I do think that we go lower over time, but a bounce here is possible, and I'll talk a little bit more on that when we get into the shorter term charts. This next level here I have at 1267, and then finally 1230. So these are the first three key support areas. My belief is we'll have a reaction on or near this line. By reaction, I mean either a pause where prices hold around that level, chop around, consolidate for a little while. It could also mean a bounce, that we bounce. How far right now, it's hard to say. I'll keep posted on that, but it's a level to watch. Now, if and when we slice through that, and of course we could just keep going down through there. I don't think that'll happen at this point, but if we were to, or when that level finally breaks, I believe the next key big support area would be all the way back down here to 1267. How far and fast we go, it'll depend. We'll look at some other things such as the shorter term charts. And speaking of such, let's zoom in. Here's a daily chart of the S&P 500. I did want to mention this 200-day exponential moving average, the red line. We are on that line. I don't want to spend too much time on it. I know a lot of traders focus on the 200-day moving average, both the exponential, which we're looking at here, and let's take a look at the Simple moving average, as you can see, we've already moved below the simple day 200-day simple moving average. However, as far as moving averages go, if I look to the left of a chart, and this is any chart, any stock I'm trading, I know a lot of traders focus on the big numbers like the 50-day and 200-day, 100-day. But if I look to the left of the chart and I see that moving average is just slight, prices have sliced through it up and back and forth, and we don't have a lot of well-defined reactions off that moving average, I don't put a whole lot of stock into it. So that's just me, folks. But you probably will hear things about the 200-day moving average, and something to watch. Maybe we do see a little reaction off there because there might be some traders or program buying that comes in to buy at the 200-day moving average. So let's watch it. Either way, below that, as I just mentioned, 1365 is the top of this support zone here on this daily chart, and that's where I think we could see some support. I see some reactions back here, quite a few tags here, and going all the way back. So again, it's just a level that I'm keeping an eye on. Now let's take a look at the SPY, the tracking ETF. The charts are going to be similar. My targets on different time frames are not always the same. There are various reasons for that, but let's just take a look at some of the levels I see the SPY possibly going to over time. These are some targets. Again, I can't say with certainty if I prefer which targets I prefer. I do think will come down over time. I do think we'll get down to this T3 or probably this T4 zone based on everything I've covered in past market videos. So we'll just have to wait and see. But either way, if you look at this nice triangle pattern here, rising wedge type pattern, we've had a very clear breakdown there. Let's take a look while we're on this weekly chart. Let's see, take a look at these fibs. Okay, these are Fibonacci time zones, and you know, I don't trade off these often, but I do find them interesting, and some of these key index charts I've left these up for a while. I usually deselect those and so they don't stand out so much. A lot of my charts look a little busy, but I have left this on there. Let's just take a look here. On these Fibonacci time zones, you start out, you drag to where you want to start out at. So I have this one starting at the peak in the 2007 bull market highs, and as you can see, each subsequent line lines up very nicely with a reaction. This one here, just a couple days off this little reaction. Now some of these are major inflection points and some of these are minor inflection points, such as this one. But if you notice here, we have the very peak of the bull market in 2007 down to the lows in 2009. This line lines up very well with. The next line gets you in, or at least indicated, a major turn in the market here, and we had this very powerful rip going from the end of 2011 into early 2012, just right after this one. And then you can see where the most recent one lined up. Now again, I don't control the spacing on these. I can set the first line where I want it and drag this first one to wherever I want, and I just find it very coincidental or not how these Fibonacci time zones line up. So there's one other set. Let's deselect this color. Okay, and take a look at these. Now those begin off the 2007 highs, whereas this set, I'll zoom in a little bit here, starts off the 2009 lows, and again, here's that initial rip off the 09 lows. There was a sharp correction, and remember the scaling on this, folks. These were some big moves back then. This was a sizable correction, the first real correction we had off the 2009 lows, and that's where I set the next line here. So that was a key inflection point. Prices then ripped up. This one didn't do a whole lot of anything. So once in a while you'll have one of these lines that just don't really tell you a whole lot. But as you can see, the next line marked this inflection point right here, from this sharp drop to this very powerful move, and that was back in July 2010. right around here. It marked this high, and then we had this sharp drop off here, and we have another one. The next one is set to come up. Let's see, date wise. If you look to the upper left hand side of the screen, I'm trying to hold this cursor on that. I can't get it exactly right now with the mouse, but somewhere around February, coming up in February. So, the reason I bring these up, this is something to watch. We don't put a whole lot of stock in these, but we'll watch. If the market continues to sell down, if this is a major inflection point that we had recently, like I believe it is, and the markets continue to sell off in the upcoming weeks to months here, then we watch the charts. We keep an eye on the daily, the weekly, the monthly charts, and see if they tell us something. Maybe there's some strong bullish divergences setting up. Maybe we've come all the way down here to the third, fourth target zone or more, and that might be a great place to go long. So take it for what it's worth. Okay, jumping forward, this is the SPY daily chart. I've covered this one quite a bit lately. Again, here's the target zones on the SPY, some different targets. Again, that's a daily chart. Now let's talk a little bit about the 60-minute. This brings me to where we're at. If you recall, recently I posted quite a bit on the QQQ, since that was the main index that I've been shorting lately. I've posted a lot of charts on the Q and some targets, and I did point out that we have come up on the second target. I believe I pointed that out today. If not, we closed right on the second target level on that QQQ 4-hour chart that I've been posting. And I did say that I expected a possible reaction or bounce. I didn't think it would be very lasting, but yet that is a target. So I think a bounce may happen here in the next day or two. How far it goes, it's hard to say, but let's just take a look at something here. On this SPY 60-minute chart, we're going back, this goes back to August of this year, just a few months. And if you take a look at these three yellow lines here, here, and here, what we have here are prices making lower lows, lower low here than the previous reaction low, lower lows, against higher highs on both the MACD and the RSI. In other words, that's positive divergence. This is more of what you would call flat line divergence, same net effect. Prices, in fact, in this case, prices made a much sharper low against the MACD making equal lows. So the MACD has not yet made a lower low. Once we make a lower low on the MACD, any divergences are then negated. And we may very well see that. If you take a look at the fast line, this blue line here, it is pointing straight down. Prices are in free fall mode, so we may overshoot that. But either way, it's something to point out that every time we've had these divergences on the 60-minute chart here, they have led to some pretty sharp bounces from those levels, as you can see here if you follow my mouse. And so that's something to keep an eye on here. The RSI has made a higher high, so we have positive divergence on the RSI. Again, it is pointing straight down. We may keep going lower, but something I wanted to point out. And while I'm on the subject, I'm not going to zoom down any shorter than the 60-minute charts. From my experience, when we're in these having sharp rallies or sharp sell-offs, or at least a powerful trend, I should say, it's been my experience that the 5 and 15-minute charts, divergences and bullish or bearish patterns just get burned through and often fail. So as a rule, I typically like to see positive divergence in place against the trend, against the primary trend, which right now is down. I like to see positive divergence in place in a downtrend, or negative divergence in place in an uptrend on the 60-minute charts or higher before my overall bias switches. So for now, I continue to remain with a overall short side bias, a bearish bias. I am getting cautious at this level, and depending on what happens tomorrow, I may begin to cover some positions or take some hedges, long side hedges against my short positions. So, alrighty. Okay, I'm going to wrap this up with the Qs. As I've stated a few weeks back, when the markets were topping, I finally thought it was a good time. I finally thought it was Apple's time to become a good short. I thought the stock would head down, and because of that and other things I saw, it wasn't solely Apple, but a lot of the things I saw told me that for the first time in a long time, it was probably a good time to start shorting the broad markets. And as far as the broad markets go, I mentioned the NDX or the QQQ is my favorite in the sector, and of course that one has led the way down on the upside, just as it's led the way on the I should say led us on the downside here, just as it led us on the upside throughout much of this bull market. So far the correction in the Nasdaq has been pretty sharp, leading the way on the way down for the markets. These patterns have been discussed in the past. We had these rising channels and wedges, negative divergences. We're looking at a weekly chart again here. So once again, we had this, prices break down from this rising wedge, come up in this channel, break down, have this unbelievable retest. Quite a rip. Markets got way ahead of themselves, especially the QQQs, and they've sold off very sharply since then. As you can see, again, negative divergences were in place. This is my first primary target. I'll get down to the 60-minute charts in a second, but before all is said and done on this downtrend, regardless of any counterbalances that we have, whether they last days or weeks, I do believe we're going down to at least this level in the next coming weeks to months. Okay, this is the QQQ daily chart. I stated on the site the other day that my targets are a little bit different on the daily and 4-hour chart, and I've been really using that 4-hour chart to time entries and exits. So we actually, I'll show it next. I believe we closed right on T2, right on or around T2 on the 4-hour chart. We're a little below the second target I had on this daily chart. But what I wanted to point out here, take a look at the MACD, the RSI. These are, especially that fast line, looked like we were going to make a bullish crossover here recently. I'm sure that had a lot of the bulls charged. We even had one here, and prices have turned down. And again, they've turned down. So that is very bearish action when you look like you have what's almost an impending bullish crossover. And they've turned down. So right now they are pointing down. And yes, we are oversold. We're at 29.45 on the RSI with 30 considered oversold. But as you can see here, if you look in the past, oversold can and often does become more oversold. So oversold alone is not a reason to go long. However, it is a reason to be on the lookout for reversal. And I would tell you this, if I was not already short this market, I would not be shorting it here. And if I was fully short, as I am, I'm looking to cover soon, start lightening up and taking some proactive measures if it looks like we're going to bounce here. Because as you can see from past history, a lot of the first tags of the 30 level have produced. If you follow the horizontal lineup, you'll see their sharp bounces off these 30 readings. So again, just something to keep an eye on. I do believe that there's probably a little more downside, but a bounce here is likely. And again, let's zoom in a little bit more on these charts. Here's that 4-hour chart I've been covering a lot. There's the targets. As you can see, we closed right on this second target that I've had listed for weeks, if not months now. 63.17 was my target. We closed at 63.20, good enough for government work, with a low of 63.18. So if we happen to bounce tomorrow and never look back, then I missed my target by 1 cent. But we'll see. I do think, as I said, the odds of a bounce have now increased. I don't see a whole lot here in this 4-hour chart that tells me we are going to bounce. So let's take a look at the 60-minute chart. Here's a nice clean downtrend channel that I've drawn that the Qs are in. We had an overthrow or an overshoot to the downside of that channel today. And just as I've talked a lot about overthrows of rising wedges and channels lately and how they usually reverse to the other side and break down, I've seen the same thing happen on falling channels and falling wedges as well. So I'm on the lookout for any type of sharp reversal that puts us back into this wedge. If you look at the MACD right here, we've had 1, 2, 3, 4 touches to basically the exact level. This is a horizontal line, and prices are there again. So in a way, this is positive divergence because we have prices making lower lows within this channel, yet the MACD is not making any lower lows. However, once again, if you look at the blue line here, the fast line, it is in free fall mode. It's not even curling up at this point. However, a sharp reversal back into this channel could do the trick. So we may slightly pierce below. Either way, this is something I'm watching for, and this has me on caution for a bounce. I'd put the odds of a bounce within the next couple days here. A pretty sharp bounce. It may be fleeting. It may last a day, 2-3 days, maybe even a few hours. But I'd put the odds pretty good of a bounce. So if you are heavily short, just be aware and keep an eye on the action tomorrow. You might want to start booking some profits tomorrow if you have positions at or near their target levels. Positive divergence on the RSI, as you can see here. So that's the QQQ 60-minute chart. All right, let's see here. Okay, folks, to wrap this up, one thing I wanted to share is the lack of fear in this market. This is one thing that's keeping me overall on a longer-term bearish bias. There will be bounces along the way, and I'm going to do my best to identify those bounces if I think they're substantial enough to exit your positions on. Again, that's the thing about any type of trend, whether it's a strong uptrend or a downtrend. It's easy to get shaken out if you try to time every little counterbounce, and the markets have an uncanny way of not letting you back into your position. So I've been trying for weeks and months now to swing these shorts down and milk the really big profits, and then I'll do my best to identify any substantial bounces that we have here. Take a look at this, and we are looking at a VIX going back to 2009, and something I wanted to point out. I drew this line here a second ago, this magenta colored line, and just take a look, and this is a price action. That line starts at the top of this correction so far here, back in September, to the current level, and look at the VIX down below. Let's just take another line here. So far over that time period, which actually I believe is about right here, a very muted reaction in the VIX. And if you go to past periods in the market, even to the same level, take a look at the VIX, what the VIX did. The fear came into the market a lot quicker. We had much sharper bounces in the VIX. Let's take a look back here. You can see, some considerable spikes up in the market all along. You can see it here. So the market has reacted in the past, a lot more fear built in. So this shows me complacency on this move that we've had here. So far, there are a lot of non-believers, and these are the things that lasting tops are made of, not sharp corrections. It's that fear comes into the market like this, that lets the market continue with these rallies. When you see the VIX shoot up, put protection is put in place, people short the market. I'm sure that's, we're seeing the same thing right now. Short interest, I imagine, is a lot lower than it was on comparable sell-offs in the past. And again, those are things that all I factor in together with the long term, with the monthly and weekly bearish charts and divergences and things that I've been talking on, along with things like this. These are things we can only watch as we go. If I was talking to you right now and I'd see the VIX up or above, the 26 level, a put-call ratio going through the roof, then I would be a little bit more cautious, and I would be taking a look at where to flip for a nice run on the long side. But as of now, we're not seeing that. So anyways, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed the video, and have a nice evening.